more accessible, more streamlined. I think where this is incredibly relevant is in the post-trade space. And this is something that has been talked about for years. In fact, I think it used to be the kind of most common refrain that you heard at conferences was the potential for DLT to transform post-trade processes. But that doesn't make it any less important. And so I'm very excited to hand over to Sanjay from Apex Group, who will be moderating this great panel on transforming post-trade workflows, the challenges of legacy systems, differences in public and private adoption, as well as programmable balance sheets and the evolution of the industry. So Sanjay, I'll hand over to you to introduce your panel.
Thank you very much. I didn't know I had to do all those things, but anyway. So I'm joined here with the esteemed panelists, Thomas, Aaron, Mike, and Greg. And thank you all for joining, and thank you for staying. We'll make it a little bit more fun-loving here. I also want to take off from what Sergey said in the previous session, using the technology stack that powers digital assets. We want to think about the technology stack that powers the traditional business of today, right? And how we can actually achieve that, because don't forget, we have got a $75 trillion marketplace globally. So just as a matter of introduction, I'm from Apex. I head Americas. I've had decades of experience, don't ask me how many decades, in this industry, and have wrestled with all the middle and back office capabilities in the traditional business. So why don't we go around and introduce everyone. And
hey everyone, Mike Lino from Matter Labs. I lead strategic initiatives. At Matter Labs, we're very focused on institutional adoption of ZK Sync blockchain technology, which is scalable and compliant infrastructure.
Aaron Kaplan, founder and co-CEO of Prometheum. We're a public market and custodial infrastructure for securities on chain that basically allows liquidity to occur once those assets are issued by handling both the trading and the post-trade side.
Good afternoon, I'm Tom Sullivan. I lead business development for digital assets at SocGen, the French bank, in support of SG Forge. SG Forge is the digital asset arm of SocGen. It's a wholly owned subsidiary focused on bringing capital markets on chain.
Hello, everyone. Good Lord.
You keep people awake.
Wow. So I'm Greg Cignarella. I think as of about 3 hours ago, I would have said head of Americas at Tokeny, but that's obviously changed now. So, and since neither Daniel nor Luke have given me a new title yet, or Peter for that matter, so I'm just going to say Apex and leave it at that. My background, similar to Sanjay's, is quite a number of years in traditional finance, banking, sales and trading, and fixed income. So the post-trade world is where I had previously quite a bit of experience.
So thank you all. I think, what we're trying to do is we're trying to say, okay, how do we take the traditional market, the post-trade workflows, and how do we digitize it? And we've heard of re-engineering, we've heard of transformation, all those things over all these years. And any consultants in the room? Probably there are. But but they've used different words like this to do the same work that they've been doing for 25 years. But now there's disruption. Now there's a complete technology stack that's powering the digital asset economy, right? So the question is, how do we leverage those technologies to actually enable? And I'm a Hindu, so I know nirvana is attainable after death. But if you had nirvana, right, everything should be on chain, everything should not be touching any human hands, and everything should be instantly, right? So having said that, how do we get there? So I'll start with one question that if you have been in this business for some time, you know that reconciliation is the business we do. We're in the reconciliation business. And then we talk about shared ledger, single proof of record, single record. So I just want to open up to my panelists and saying, okay, what do we have to do? What does it mean? What does a single book of record mean? And what does it mean that, how do we shift to the single book of record from silo systems, people surrounding the systems, doing the reconciliation, not sharing information, and not sharing it instantly, of course. So what kind of operational issues, aspects that we'll have to figure it out to get there?
Yeah, I guess I'd start here. So a lot of people, when they think of single book of record, they automatically think efficiency gains, but a lot don't think of the operational risk that comes with that. And just as an example, when it comes to operational risk, when you're using some of these single books of records, you really do need shared governance standards across the organizations that are using that single record. Aaron, you might not agree with that one, but, and then also, I do think that it's pretty important to have this rule book when you're using something like a single record that everyone agrees to. So when it comes to blockchain and distributed ledger tech, there's a lot of nuances around things like legal settlement, and then also a lot of different nuances when it comes to different jurisdictions.
So when we look at traditional securities, or electronic securities, I guess is what they're called today, you have a lot of different participants in the life cycle of that asset, whether it's the transfer agent, introducing broker, your trading venue, your clearing firm, the DTC, whatever components are there. And as Sanjay mentioned, all their data is siloed. And that leads to a lot of issues in that each place has to reconcile to make sure that everything's kosher at the end of the day. But when assets move on chain, basically you have this centralized database that's decentralized. That's weird. But essentially, that will then allow a lot of those inefficiencies and those siloed sort of issues that occur to be eliminated. It just becomes a question of having both the access to the investor base such that it makes sense to issue those assets on chain, such that it can overcome the fact that the transition will occur from electronic to digital, and then also having the additional sort of infrastructure to allow those assets to do what they do currently. Because moving securities on chain, they just need to be better than what they are currently, and as long as it's less expensive, it will occur naturally as sort of this inherent process from electronic to digital.
So, I mean, from my perspective, I talked about what I did, what my role is today. I didn't talk about what I've done in the past. So I spent 20 plus years running operations teams and running operational functions. I got into blockchain because of the fact that I ran reconciliations teams and the number of people that we had. So I've done a little bit of analysis in terms of how we operate. And you can think about reconciliations in two ways. One is what you do internally within your organization, and the other part is what you have to do externally. So depending on the type of security, the type of product, the type of life cycle that you're talking about, within my organization, a transaction can touch somewhere in the neighborhood of 60 systems. That means 60 reconciliations that we have to do just internally. So when we're talking about using this technology, we don't have to say to go from 60 to 1 or 2, but even if you go from 60 to 40, that's a big savings. And then the external piece is the other part that's really important. When you're reconciling each trade or matching each trade to each counterparty using information that's booked in our systems and your systems independently, if you can use the blockchain as a shared source of truth, that is I'll use your word, nirvana.
One thing I did want to add is when I used to work at Deloitte, I used to work on the circle audits. And I will tell you one thing, there's definitely still reconciliations. So for people to trust USDC, you need a third-party auditor to come in and reconcile that the assets underlying that stablecoin are really in places and match one for one to the USDC outstanding. So it's really shifting a lot of those processes that you're used to from reconciliation standpoint to other places, not eliminating it.
So let me just add, I have a lot of sympathy for Tom, because that's a lot of, like many of you here, as I mentioned before, I come from traditional finance, sales and trading and fixed income, which was a lot of transactions. And it was, we didn't really even understand it at the time, what normal meant, because this was just the way that we operate every day. It's the only ecosystem that we were aware of. But it was a nightmare. I mean, at Tokeny, the way we think about utilizing our technology and how do we apply it, we always think in terms of pain points. What are the pain points in the industry, and how do we adapt blockchain technology and solutions to those type of pain points? And it could be capital calls, it could be corporate actions, like anything that can be programmed into a smart contract. But in my case, it was roughly 2016 when I kind of discovered crypto, which my wife likes to fondly recall as my degenerate gambling days, but she knew me during .com trading days as well. So, but it's at that point that I really started understanding what blockchain was all about and distributed ledger. And to me, it was this awakening, because after so many years in that transactional phase, and there was a reason why we were T+5, T+3, T+2. I mean, there was a reason. There was so many intermediaries, so many different points of failure along the way. It's actually amazing anything ever settled at all. So when I really started discovering what it was all about, it wasn't It was only a couple of years later that I moved into this space because I just said, there is no way that the industry can continue the way it's been for decades, right? I mean, we went from paper ledgers to, computer systems in the 80s and 90s, great, but in fact, we've hardly have changed. And those reconciliation issues that they're grappling with today, maybe there's been some productivity gains, but not anywhere near what we're talking about in terms of altering the way the industry operates, utilizing distributed ledgers. And yeah, I agree with Mike said. I think there's always going to be reconciliation that has to be done. But from a volume standpoint and the trade breaks that we've had to deal with all these years should be largely eliminated. I'd like to at least foresee and hope for.
So I was the guy fixing those breaks, and you were the guy yelling at me.
Yeah, get it done.
Yeah. So I think you touched on data, which is important. Data is old as soon as you move it, and it's unreconciled as soon as you move it. That's the point. And I think the single source of truth, the auditability and traceability is what's lacking today in spite of doing all the reconciliation. When you have to say, where did you get that information from? To unravel a report all the way back, you have to have an army of people to help you do that. So that's the pain point today. So having said that, when I look at, when I look at JP Morgan and they say, we've done on-chain settlement of treasuries, and then we look at SocGen, they're saying we are going to be production ready soon using some of the technology stack which is powering the digital assets. What does that mean? What do we have to do to overcome that? And how do you change that culture? How do you shift it? What's the operational element? Is it something that can be done inside out, mean from inside you evolve to that state? Or is it outside pressure coming in to evolve to that state?
So maybe just I'll correct you first and then answer the question. So we're not ready. We've been doing this for 5 years. We've issued a number of securities natively on chain. We issued a stablecoin in 2023. It's now one of 2 stablecoins that are MiCA compliant. So we've been at it doing things in production. We actually use an application provided by Broadridge called DLR for the past 3 years, where we're moving treasuries in token form for our repo business. We move $1 billion to $3 billion per day on the platform. So we're doing it, and I think that we're at the next phase of how do we bring it to real scale? Because $1 billion sounds like a lot in crypto, but it's not so much for for those who work in big banks.
Yeah, maybe just to add to that, I would say that we are production ready. There's a couple other platforms outside of Broadridge that do a ton of volume. One example of that is Baton Systems. They've done over $17 trillion worth of volume in its existence. They focus heavily on payment versus payment or collateral management. And then also another example is HQLAX that also focuses on collateral mobility in regions like Europe. So I would say we're definitely production ready. There's definitely kinks that we need to figure out, but we're working through it together as an industry.
Yeah, I mean, this is all part of the transition, again, from this electronic to digital. I think why we've seen sort of these products be issued, and obviously SocGen's been doing it a long time, Otter Labs has, but essentially there's been a lot of interest on the tokenization side and on the issuance side, but it sort of creates a new set of problems in that if you're going to tokenize something and issue it, the goal is to have the efficiencies of it being blockchain native, but you also want to have the same amount of access, meaning it be available, that product to be available to investors in general. And a lot of what we've seen with like tokenized funds and stuff is basically they've tokenized it, but you're getting access to less investors. You're using sort of both old and new systems, because you're still using legacy transfer agent systems in addition to using the blockchain as a second books and records. And that actually, in theory, could make it more expensive. Now, one of the ways to overcome sort of this, like, I don't know, we want to call it this, like, catch-22 or this trap, is basically to have market infrastructure. And we've seen a lot of action on the regulatory front, and we've seen that infrastructure start to come online. I mean, whether that's on the security side for custodians that could custody digital assets, and now with ATS is coming online. And it's just now a question, and it's just that with the ability for now more brokerage firms to get involved based on the most recent FAQ from the SEC, I think all these things will conflate together, and that once you have the market infrastructures, you have the buy-in from the major institution, and basically now you're ready to rock and roll. So what we've been sort of like moving slowly towards a major like accomplishment here, I think that this is the year you're going to see sort of those ubiquitous products come online that are blockchain native, that are actually securities.
Greg, do you want to add to it? Or?
Well, I was told to bring my mic closer, but the last time I did that, I almost broke the windows. So I'll find a happy medium in between. Right. Well, when it comes to production ready, one of the benefits of Tokeny being an 8.5-year-old company is that we've been active in that very space of bringing security tokens on blockchain. Let's not forget, though, in the world of securities, whether it's, we're agnostic in the jurisdiction, but just to pick the U.S., if you're bringing an instrument on chain, well, you still have to, there's all the compliance rules that are required. So you're still creating in the private market space, a Reg D, a Reg A, Reg S, Reg CF, you're still doing all that. So it has a life off chain, and then you're creating naturally a digital representation of that on chain. And it has all the compliance rules baked in the cake. That's the entire intent and all the control mechanisms. So it's been quite active. I would say, to echo the previous comment, I think it feels this year and going into next year as well, it feels like we're trying to hit that launch parabolic phase. Are we mainstream yet? No, certainly not. I don't think we're at a point that it's common knowledge in the industry that we are at a point of transitioning, that point of transition of no return from the traditional markets where they have always operated into blockchain based, but certainly a heck of a lot better than it was a year ago or even 2 years ago. So it is quickly getting that way. But I have former colleagues who I speak to who didn't even know how to spell blockchain 2 years ago. Now they're asking me questions about it. So it's getting there.
So thank you very much for that. So, one of the other things that's happening, and so some of the technology stacks that's being applied in the digital asset world is programmable assets, programmable workflows. So can you give some examples and evidence of how these two items or these two technology stack has helped in automating the workflow, especially in collateral, compliance checking, or any other processes on transaction processing that you have actually evidenced or you have actually implemented that could be really helpful to the audience here?
Maybe I'll start. So on ZK Sync, there's a platform called Tradable, and they've tokenized over $2 billion worth of private credit. And as part of the platform, they automate distributions and interest payments, and those could all be received via USDC. So that's a huge benefit. And then also they did automate capital calls as well, which is another unique feature that they've utilized smart contracts to enable.
So before we move on, what challenges you had to face to put those kind of technologies in? Or you did not?
No, it wasn't an easy journey. It was certainly over the course of a year or so of the technology build. And then also a lot of these platforms have a cold start problem. Tradable is partnered with a company called Victory Park Capital that recently was acquired by Janus Henderson. So having that backing and support also helped drive initial volume. There's over 34 assets that have been tokenized, and there's a wide variety of investors. And what's unique about the platform as well is that these are TradFi investors, not on-chain capital on the whole. So you get a good mix of traditional capital as well as on-chain capital. As you guys all know, on-chain capital is not as big, anywhere near as big as off-chain capital. I was actually looking at the stats recently, and DeFi TVL is only like 100 billion, and that's only 10 bips of the total fixed income market of 140 trillion. So we're still really small.
Anyone else want to add to that? Or?
And the ability to use smart contracts in the creation and distribution of assets allows you to do things that currently aren't possible. So to give an example, like on a money market token, you could do a distribution or an earn every hour, right? And that's not possible currently with current systems. But with everything being on chain and basically having instantaneous settlement, all the other benefits there. Second time I touched your leg. But essentially, there might be a third. But essentially, that will then allow for new products to be created, new investment strategies, basically different things that, again, will probably mirror, possibly on steroids, what happened when trading went electronic. If you think about it, paper trading was really prohibitive in the terms like there was no ETFs, there was no structured products, the volumes were significantly lower. Imagine that occurring again as there's instantaneous settlement, you have capital efficiency, and everything moves on chain, right? So basically you could have the potential for new products, new strategies, structured products on steroids, customized structured products, like the things that will really meet your customers' needs on a bespoke level that were previously impossible. And I think that like
these are obviously part of the reasons, but this is all part of this transition to digital and why it's occurring in the first place.
Yeah, I mean, I would just add that, in terms of real, examples, say, a couple of weeks ago, I was, had the privilege of participating with the DTCC's Great Collateral Experiment. And of course, it was a test, not a production. But what it demonstrated was we could deploy different types of assets to be used in collateral, as a means of collateral to secure both depositories and swap transactions, and to do it in real time. So in that case, we used a version of our SG-Forge's stablecoin where we were able to deploy it on chain and transfer it instantaneously. And that's something, collateral from a use case perspective, collateral management is, a huge opportunity for the traditional finance industry to improve upon. And that was just one way to demonstrate that it can be done and can be done across the world.
Starting route to 340 South End Avenue.
A lot of traffic?
All right, we're shifting the avenue now to, where was that?
Microphone for that.
Go ahead, Greg.
Just one other thing to add, though. So when it comes to private market security issues that, we get hit with that frequently, and it's actually quite interesting to see issuers who want to think of any potential use case in the private market space. We get hit with it multiple times a day, and it's actually quite interesting to see what people bring in on chain. But when I'm on the phone with these clients, I always want to ask why. Like, why are you thinking about it? And you get a variety of different answers. A very common one is, well, there's two sides to it. The very common one is they want to provide their investors with some form of utility. So I know we're going to get into this topic, but it's the promise and the expectation of an on-chain secondary market capabilities, and we talk a lot about collateralized lending as well. So we bring utility to a private market security that in today's market has virtually none, or very, very little. But then the conversation also goes back to them, the issuer, like, how do we make their life easier? So certainly, it's almost at its most elementary state. You want to ensure KYC, AML, identity, and accreditation. That's all taken care of. Now, Tokeny, we don't do that directly. We have third-party providers that do that. So that checks a box, but that's only the starting point. To make their lives easier on a going forward basis, they want to understand, well, there's a lot of, again, going back to pain points, there's a lot of things that me, the issuer, that I'm responsible for. So they always talk about some form of revenue distribution. It could be dividends, it could be rent rolls, so anything, or coupon payments. So we took the added step and we created a series of smart revenue distribution smart contracts. Now it doesn't work for everyone because it does require the wallet-to-wallet transfer of on-chain payments. So think of a stable coin sitting in an issuer's wallet being transferred to investors' wallets on a pro rata basis because the blockchain is real time and we're reading it and we know exactly what everyone's token holder's position is. So that's programmable and it's basically done. But you can't really do that if you also want to pay. We're not an off-chain. We're not in the fiat space. So it either has to be one or all. I can't program half and half. So that's kind of where we are right now.
So, no, thank you for that. And I think, going back to my experience, I hear about data token, asset token, and the token has got all the rules embedded into how the data can be used, where it can be used, why it can be used, and when does it expire and when does it live, right? So you build all those rules and then you cannot change them. And as a token, so if you look at telecom industry today, when Trump talked to Putin yesterday, I'm not being political at all, sorry, it went through so many internetworks, and he didn't have to think about which network it's going through and everything. It was interoperable all the way through. There was a charge for that call, and how it was split across various channels, various telecom companies, was up to the telecom companies. So they have got it done. So when I talk about that, that's true interoperability. How do we achieve, when you have done some of these exercises, how do we, what is the state of interoperability today to achieve some of these things? And where do you think it's going? And how can we get there? I know this will take all night, but briefly.
The issue of fragmentation with having certain digital brokerages or digital custodians being able to only service or support certain assets that don't interact with other digital custodians makes life difficult. And obviously this isn't a problem that has to be overcome in order for the sort of digital asset industry, particularly on the security side, to become ubiquitous. But at the same time, like, there's it's important that there are standards. It doesn't necessarily have to be one. And basically, that involves some sort of like ecumenical type council, which says like, that's a bit of a tough one. But the danger on the back end side of that is that if there's too much centralized standardization, you have a recreation of a new consortium, a new DTCC, a new Swift type component, right? And so it's how do you balance these components here? On the one side, you do want there to be standards, you do want there to be interoperability, but you don't want the industry to be controlled by a bunch of dudes in a room that you see nothing inside of. Right, so it's sort of like the same concept of like, how do you do a CBDC with maintaining privacy? Right?
Well, so having chaired a lot of committees at Swift, so are you saying Swift doesn't have a role to play in the standards in the future?
No, I think Swift does. I think that's an actually really good use case for Swift when it comes to the digital world, right? But like, I think Swift is a little bit. Actually, no. It's definitely has a role. I don't know if it'll be the traditional role it plays now, currently, with being the messaging system and the protocol.
No press in the room.
No, but Swift is doing interesting things. I mean, Tom from Swift, their CI, the Chief Innovation Officer, is an intelligent dude and is pushing it forward, and I enjoy talking to him. So
it's more collaborative setting of standards instead of someone dictating it down to you, is what you're suggesting, correct? Right? Sorry, didn't want to put you on a spot, but please.
I mean, I think from our vantage point, right now it seems to be a problem, and given what Mike was talking about in terms of the size and scale of the markets, it feels like a bigger problem. It feels like a big problem. I think it's a problem that will resolve itself, both through technology that exists. We know it. I mentioned the DTC project. That was it showed mobility cross-chain, so that can be done. I mean, Onera is here. There's Chainlink is here. There are solutions to those problems today. I think, from our vantage point, we want to be where the market is, so we can issue product on a variety of chains, and we think that, and one example that where it's in some ways doesn't matter as much, and it goes to, some of the private securities, is that you want to have greater mobility, but right now, you take an asset, many assets, and they get parked in a garage, and they stay there, and they don't get used at all. So if you improve that by getting some financing against it or something like that, then that's great. It doesn't have to be available to everybody across the world. So and that's kind of how we're looking at it. When we issue structured products, and it's one of the things that we'll be working with Aaron and Prometheum to be able to distribute. We issue structured products on chain. If we can get better utility from them than we do today, when somebody just buys it and holds it and it sits in their their account at Schwab, that's a better situation. So it doesn't have to be solved tomorrow. I think it'll be solved.
So Thomas, question there. So because there's a lot of flexibility, and they're programmable assets, right? Are you suggesting that in the TradeFi world, so digital assets, the new asset class, everything else, you could actually curate products which are specific to certain client needs, and do hyper personalization, and then put rules around it, and have the trust, if we are able to apply the tech stack of the digital assets, the person can have confidence that the product is being executed and compliant correctly. Is that correct?
100%, yeah.
No, I would agree. Sometimes people do characterize it, like you just said, as a new asset class. In truth, it's not really a new asset class. It's a way of taking the securities that investors have always wanted. Issuers use it for great purposes to raise capital. Investors do it for their obvious reasons. But the system was broken. We just never really knew it because that's all we had. The advent of all this technology means that this is what we have to evolve to. And when it comes to the subject of interoperability, I mean, there are a lot of experts just at this conference who are tackling the problem in a fantastic way. You mentioned Onera and Layer Zero and Chainlink. And the problem, I don't necessarily see it as a problem, but rather a part of the infrastructure layer within how securities are going to move. That just needs to be worked out over time to something that's acceptable, not just to us market participants, but regulators as well and compliance officers. They're going to have a say in all of this. It's just going to take more time to work itself out, but I'm pretty confident of it.
And these solutions that exist today in the digital asset world are better than the ones that just exist in TradFi when you have to move assets from DTC to Euroclear to wherever. That's a pain in the ass. Sorry.
And
Something
Greg,
you would have yelled at before.
thank you. And Greg, you're right. But think about this, right? And I'm going to date myself. Interoperability being trying to be solved for 30 years. Standards are being trying to be set for 30 years. So it will take some time. I think the digital asset space, at least the tech stack on the digital asset space, is moving at a faster track, right? And there are people who want to make change happen. So we'll have some questions open for people. I've only got 36
Just one point
seconds.
on the interoperability quick. On the assets moving on chain. This is just occurring because people will save money. Whether it's the customer, whether it's the institution, everything will just be more efficient from a cost perspective. So while we're in a stage right now where there are certain difficulties and inefficiencies that are being ironed out, it's the people who are ironing out those efficiencies that will be disrupting how the electronic markets work and how be like the big players in the digital markets.
So someone told me this, and correct me if I'm wrong. If we were able to apply the tech stack of digital asset to the TradeFi, we could do three things. We could settle anytime, anywhere, any place, 365 days, 24 hours, number one. Number two is we could have a 95% improvement on efficiency. Something costing $1, it'll cost 5 cents. And the client satisfaction will increase almost 2x to 3x because of transparency and instant access to information. Would you all agree to that? Or would you think that's a right trend?
I have to be careful because compliance is giving me an issue. You can't say specifically how, like, that 95 cents on the dollar you're going to save, or 95 bips. Like, it's not going to work like that. Will it be significantly less expensive to do almost everything involved? Yes. There's been, like, rumors about people moving their back offices on change, major, giant entities, and, like, they're eliminating 80 to 90% of their, like, human capital, like, their operational needs from a human standpoint. Think about that alone, right? That's a major, major savings. So
I did see a stat recently around collateral inefficiency, and that if a bank was able to move their assets on chain and utilize some of these collateral mobility solutions, that they would save up to $75 million. Now, I don't know where that stat came from, but it's still a big number per year.
Well, can I ask one more question? Come on, one more. It's on public versus private blockchain. That's a very...
You don't want to get in trouble with
Thanks,
Mike.
everybody.
Thank you so much, all. It was a fantastic panel, and I'm sure we could have kept going, but luckily there'll be plenty.